Markets have delivered strong gains, but those gains continue to come from a narrow set of stocks. We'll cover what this means for investors and more in today's quarterly investment perspective. What drove markets higher and where volatility showed up in 2025? 2025 was another strong year for stocks, supported by resilient economic growth and solid corporate earnings. Much of that strength came from the familiar small group of large technology companies, which continued to deliver strong profit growth and command investor attention. Investor confidence was reinforced as inflation continued to ease and central banks maintained a gradual path toward lower interest rates. Borrowing costs eased and access to capital improved, helping stock markets recover from periods of stress, while bond markets also benefited from declining rates alongside still relatively high yields throughout the year. But uncertainty wasn't absent. In April, markets experienced a sharp but brief sell-off tied to rising geopolitical and trade tariff concerns around what became known as Liberation Day. Stocks came close to a 20% decline before stabilizing, as fears of immediate economic disruption faded and trade actions proved less severe than initially expected. Later in the year, volatility resurfaced at times, particularly in technology-focused areas, as investors reassessed how quickly heavy spending on artificial intelligence would translate into near-term profits. Even so, markets ended the year supported by resilient earnings and a policy backdrop that remained broadly supportive. Why stock and bond markets may advance more gradually from here? Looking ahead, U.S. stocks are likely to continue trending higher, supported by steady earnings growth and a policy backdrop that remains accommodative. At the same time, elevated valuations suggest returns may be more moderate, with periodic pullbacks tied to earnings results, interest rate expectations, or geopolitical headlines. Market leadership may begin to broaden beyond the largest technology companies as profit growth becomes less concentrated. Those dominant firms should remain important drivers, but investors may see a wider set of companies contributing to overall returns. International stocks may continue to build on recent momentum as easing policy support helps narrow the growth gap with the United States. Improving earnings trends and more attractive relative valuations abroad provide a constructive foundation, even as geopolitical risks introduce intermittent volatility. In bond markets, stability in central bank policy should remain supportive. Short and intermediate term yields are likely to remain anchored, while longer term rates may fluctuate in response to government borrowing needs. Overall, bonds continue to offer income and diversification benefits in a more balanced market environment. How the economy slowed but stayed on its feet in 2025. The U.S. economy cooled modestly late in the year, extending a gradual slowdown that unfolded throughout 2025. Interest rates remained high and weighed on activity, but growth held up. Consumer spending continued, though at a slower pace, and business investment softened outside of the tech sector. Hiring slowed further, but deceleration did not come with a meaningful increase in layoffs. Inflation continued to trend lower, giving the Fed room to continue easing policy. A late-year government shutdown likely weighed modestly on activity, though its effects appeared limited. Abroad, growth stabilized after a choppy year. Europe benefited from easing inflation and lower rates, and Japan saw firmer growth supported by domestic demand. And emerging markets experienced steadier activity as inflation cooled and central banks shifted toward rate cuts. China remained constrained by property sector weakness and ongoing pressures tied to local government finances and consumer demand, though exports and targeted policy measures provided pockets of resilience. Why the economic backdrop still supports expansion. Looking ahead, the U.S. economy is likely to grow at a steady and sustainable pace over the coming year. Easing monetary policy should gradually improve conditions for households and businesses, even as hiring and spending normalize from prior highs. As inflation moves closer to the Federal Reserve's target, lower interest rates should support borrowing and investment decisions over time rather than all at once. Fiscal measures, including the phased impact of tax changes beginning in 2026, may add incremental support to household spending and business investment. Productivity gains, particularly from increased adoption of artificial intelligence and automation, should help support underlying momentum. Businesses are continuing to invest in efficiency, which can help sustain earnings growth and real incomes over time. Globally, growth should broaden modestly as central banks continue easing and inflation pressures recede. At the same time, geopolitical tensions and trade uncertainty remain risks that could lead to uneven growth and periodic volatility across regions. Narrow market leadership and higher expectations. Are we in a bubble? Are we in a bubble? It's a fair question. After another strong stretch for stocks, valuations have looked elevated and market leadership has remained narrower than many investors would prefer. When a small group of large, highly visible companies does much of the heavy lifting, it naturally raises concerns about how dependent market outcomes have become on a limited set of drivers. A more useful way to frame today's environment is not bubble or no bubble, but expectations versus fundamentals. Unlike classic speculative periods, many of today's market leaders are profitable, cash-generative businesses with strong balance sheets. Current valuations reflect both strong earnings today and high expectations for future growth, not the absence of solid underlying fundamentals. Periods of narrow leadership are not unusual, particularly during times of rapid innovation or economic transition. Where risk becomes more tangible is concentration. When returns depend heavily on a narrow set of companies or themes, especially around artificial intelligence and the infrastructure supporting it, markets can become more sensitive to shifts in sentiment or changes in expectations. This dynamic explains why markets can experience sharp but short-lived pullbacks, even when the broader economic and earnings backdrop remain supportive. Importantly, this pattern alone does not signal the end of a market cycle. Historically, bull markets tend to unwind when there is a clear catalyst, such as sustained earnings downturn or meaningfully tighter policy. For long-term investors, the takeaway isn't to predict the next pullback. It's to make sure your portfolio reflects deliberate choices rather than reactions to headlines. Understanding what's driving outcomes, where risks may be concentrated, and whether those risks align with long-term goals and time horizons. Balancing opportunity and risk in a narrow market. One defining feature of today's market environment has been the concentration of returns within a relatively small group of large companies, particularly those tied to technology and artificial intelligence. While this pattern is a normal part of market cycles, it can increase sensitivity to changes in sentiment, earnings expectations, or policy signals. In this environment, portfolio management is less about predicting short-term market moves and more about maintaining balance. Within public markets, that means diversifying stock exposure across sectors, company sizes, and regions, while balancing stock market risk with high-quality bonds that can provide consistent income and help dampen volatility. Bonds continue to play an important role in portfolios, offering income, diversification, and flexibility during periods of uncertainty. Their role becomes especially valuable when stock markets experience rising volatility and acute declines. Beyond public stocks and bonds, select private investments can further broaden sources of return when used thoughtfully. Private equity, private credit, real estate, and infrastructure can provide differentiated return drivers, higher potential income, inflation protection, and exposure to long-term structural themes not always captured in public markets. These investments, though, introduce trade-offs around liquidity and complexity, making alignment with short-term and long-term objectives especially important. Markets will continue to move through cycles. A disciplined approach, grounded in diversification, appropriate risk exposure, and alignment with goals, remains the most reliable way to participate in growth while managing uncertainty over time. At Capstone, our focus remains on helping clients stay invested with confidence through thoughtful diversification, disciplined planning, and a clear long-term perspective. Thanks for joining us for this quarterly investment perspective.